Well, the first thing to say, of course, is it's our birthday. We're 200 years old now. We were 200 on the 1st of January 2017, partway through last fiscal year. But when I look at the results were strong, principally though helped by foreign exchange, the translation of our foreign results into sterling. If we exclude those, we had some modest growth in sales, about 3%, and our operating profit was around about flat. But generally pretty good results when I look at the market backdrop. And the other thing to mention, of course, is the cash performance, which was also strong. Looking then at the technology, we made some really good progress on delivering on our strategy and delivering the technology for the future. Particular highlights I draw out is the improvements we made in battery technologies, battery materials, particularly our development of high nickel materials, which we're making great progress, but also our development of our API, that's active pharmaceutical ingredient, pipeline in our health sector, where we're making real progress. And finally, of course, for our shareholders, we've increased, well, the board's recommending to increase the dividend by 5% for this fiscal year. So yes, in the second half, our sales were up by 6% and our operating profit up by 4%. And that compares with the 3% growth in sales for the whole year and flat operating profit for the whole year too. So stronger in the second half than the first half. And the two major drivers to that would be in process technologies, where our catalyst orders tend to be towards the second half of the year normally anyway, and we had a very strong last quarter in particular of this fiscal year. And finally in fine chemicals, that's where we had the Defetilide, the launch of a new drug, which launched in June last year. So of course, therefore, we had more of weighting into the second half of the year than in the first half. So those would be the two principal reasons behind that outperformance in the second half. So yes, the markets in some of our areas have been quite challenging. And so but having said all that, we still delivered progress and grown the business in the year gone by. So what are we doing about it? Well, we've taken some costs out in some parts of the business. So we talked about that 2 years ago, and we've delivered what we said we would. And going forward, I think we've got some further costs to take out of the business too. But we're also continuing to invest in the business. Last year, we invested over £400 million on R&D and capital expenditure across the group. So it's all about making sure we get that right balance between the short term, where we need to deliver the performance, even though the markets are challenging, but at the same time continuing to invest into the future, which is what we've done. Yes, ECT did have a very strong year last year. We outperformed in almost all of our markets relative to the car or truck production numbers. Particularly strong in Europe, where we're working with the car companies, the OEMs, to come up with solutions to meet the tighter regulations for emission standards. And of course, as we all know, emissions are becoming a much larger public issue. In Asia, we've also had some good growth with good strong growth in car numbers. But the area of the business that's holding us back a bit has been our heavy-duty diesel business in North America, where the market has slowed down quite significantly over the last year. Whilst we'll still outperform that slowing market, that has pulled the business back a bit. But we expect that market to recover, and it is in fact recovering already. So in the other four divisions, I'll start with process technologies. In this division, they've maintained their market shares and they've continued to invest in the business to make sure that we maintain our positions going forward. Taking advantage of the fact that we made a significant amount of cost savings in last year too, but at the same time there is still overcapacity in the market for the products that our customers need, and therefore new plant builds are few and far between in the current environment. In Precious Metal Products division, we've benefited from slightly higher precious metal prices, but more importantly the self-help measures we put into place to manage our refineries in a much more efficient way. In fine chemicals, whilst we made progress in developing our new API portfolio and launched the APIs that go into 2 new drugs, which were launched this year, that has not managed to offset the slowdown in the ADHD market, where we make the APIs that go into those drugs too, and those have been quite significantly hit in the last year. Finally, in new businesses, We've made some progress in our battery technology division, and we've also made further progress in fuel cells, where we're moving towards a break-even business, which we expect to deliver this year. So the year we just finished is a year where we've had no new legislation across the world. But going forward, we can see lots of new legislation coming in China and India as they catch up with the rest of the world's legislation and go towards Euro 6. And we expect that to be in place in the early 2020s. And we're well set up there using the technology we've got in Europe and America, taking it over to China and India, and then applying a fit-for-market solution for that particular market. Coming back though to Europe, we've got new legislation coming for gasoline cars, petrol cars, so-called Euro 6C, but also real-world driving emission standards. And both of those two things will drive growth in our business in the short run. At the same time, we're investing in our capacity, making sure we have sufficient capacity to meet those demands, but also making sure that we're as efficient, as flexible as we possibly can be, which is why the board approved a new plant in Poland a couple of months ago, which will be ready hopefully in 2019 as this new market comes forward as a result of that new legislation. So for the year we're now in, 2017-18, I expect another year of progress, certainly growth at the top line, and when I add in some of the cost savings, the underlying business will make progress. But we're going to be held back by a couple of non-cash items, one to do with pensions and one to do with the fact that the credit that we had in the year just finished won't be available to us in this year, and as a result our profits will probably be broadly flat, but on a cash basis will be ahead. When I roll forward into the future beyond that, I think the outlook is still very positive off the back of the momentum we've got in the existing business, and some of the cost efficiencies and investments we're making into the future will be able to drive real progress into the years ahead.